Are we going to get a supply shock in Bitcoin? Today, I'll talk about the idea of a supply shock. I'll tell you what it is and my take on it. Pretty much every cycle, when Bitcoin price begins rising, because it's so amazing and so mind blowing how fast it rises, it also fuels expectations of commentators and influencers um, to a crazy level, and people begin to provide these astronomical price targets. For example, um, you know, things like getting to 1 million by the end of next year. These are possible, but whenever I talk to people who kind of throw out these numbers, they say, Bitcoin can surprise us. Anything is possible. For example, if we get a supply shock, what is that supply shock? Basically, what they argue is they assume that Bitcoin is illiquid, meaning most people who buy Bitcoin don't really want to sell it until the price is much, much higher. And because of that, over time, coins are being taken off the exchanges and stored in long-term storage. No one is selling. So over time, you actually get more and more illiquid, and the supply dries up. When there's no supply, new buyers have to pay astronomical prices. This makes sense, except if you consider that illiquidity of Bitcoin is a function of price itself. So what these people are missing is that as Bitcoin price goes up, a lot of the previously illiquid coins become liquid. When you look at on-chain data, you can prove that this is actually happening. So I have here I just looked at one statistic for you. Just recently, since Bitcoin price went from 62K to today's 100,000, long-term holders have sold 1.2 million coins. So their supply, they previously held 14.2 million coins, and right now they hold 13.4 million, which means they sold 1.2 million, which is assuming a price of $88,000. That gives us about $1 billion of sell pressure. So just as you were assuming that so much buying power will explode the price, $1 billion of sell pressure came into the market as price went up. So essentially, people who think supply shock is a real phenomenon and can cause massive astronomical price appreciation, they miss the fact that Bitcoin, like everything else, is a market. If Bitcoin is actually illiquid, it's a lot less useful. This is actually a global money. It's extremely liquid. You can sell it at any point. You can buy it at any point, at any hour, at any geography. So it's actually very, very liquid. As soon as the price goes up, so many new buyers show up. People want to use their money, and when it appreciates significantly, coins will come out of cold storage. Not all of it, of course, but a small portion will be used for funding lifestyle or other expenses. No one wants to hold indefinitely, and everyone has a price. Okay. Now, another way to think about it is you would have gotten a supply shock if there was no new supply coming online. But as soon as you are, for example, let's say a huge amount of buying power comes into the market, coins are about to run out, and that can actually happen, very few sellers available. And then a new buyer would have to pay very high prices. Okay, for example, the price because of that might go from 100,000 to 200,000, but it wouldn't go much beyond that, because right before that happens, tons of new supply comes in, and then the price gets suppressed. And that's where you get these long consolidation periods, actually, right? So after ETF approval, we got that massive jump in price, and then we got 7-8 months of consolidation or slow bleed in the market. That's exactly what's happening. Price goes up, people begin to sell, and you just need to give it time. So you can't go crazy with these supply shock extrapolations. Bitcoin needs time to grow, and it's on a positive path. It's going to be the fastest growing asset for the next, several decades. However, it's important to be realistic and don't assume that economics will just break for Bitcoin. This is all a supply and demand issue, and sell pressure is a function of price. More people will sell as price goes up, but over time, a lot more buyers will show up as well. Okay, thank you guys.